Most people think you need to be 18 to start investing, or worse, they think you need thousands of dollars. Both are wrong. In fact, a 16-year-old with a part-time job and a simple custodial account could retire with over $2 million, more than someone who waits until 25. That's not a typo. The single biggest predictor of wealth isn't how much you earn, it's how early you start. And if you're a teenager or college student right now, you have the most valuable asset on earth, time. If you stay until the end of this video, you'll know exactly how to start investing as a teen or college student, even with just 20. I'll show you which accounts to open, what to buy, and the one mistake that derails most young investors. By the time you graduate college, you could already have a 5-figure portfolio without working another hour. My name is your name, and today we're giving you a financial head start that most adults would kill for. Let me start with a story that will make you want to start today. Meet Jake. At 16, Jake got a summer job lifeguarding. He earned $2,000. His dad helped him open a custodial Roth IRA. Jake put $1,000 into a simple S&P 500 index fund and forgot about it. He didn't add another dime for decades. By age 65, that $1,000 had grown to over $88,000 tax-free. His friend Mike waited until he was 25 to start investing. To catch up to Jake, Mike would have had to invest over $500 a month for 40 years. Jake won the game before it even started, just by showing up early. That's the power of starting as a teenager. Every year you wait, you need to save 3 times as much to catch up. So if you're in high school or college right now, you have a superpower. Don't waste it. Now, let me break down the practical steps, because the rules are different depending on where you live and how old you are. Step 1. Before you invest a single dollar, build a tiny cushion. Asterisk, you don't need 6 months of expenses like an adult. You need $500 to $1,000 in a savings account. That's your I need a new phone or my laptop broke fund. Keep it in a high-yield savings account, not under your mattress. But don't obsess over this. If you have $100, you can start investing $50 and save $50. The habit matters more than the amount. Asterisk. Step 2. Understand the legal rules for your age and country. This is where most teens get confused. In the US, if you're under 18, you generally cannot open your own brokerage account. You need a parent or guardian to open a custodial account for you. There are several types. The most powerful for young people is the custodial Roth IRA. This is an account where you contribute after-tax money you've earned from a job, and it grows completely tax-free. When you retire, you pay no taxes on the withdrawals. And you can withdraw your contributions at any time without penalty. If a parent opens a custodial Roth IRA for you, the money is yours. You just can't access the earnings until retirement. Even a teenager with a summer job can contribute up to the amount they earned, or $7,000 in 2026, whichever is less. If you earn $2,000 babysitting, you can put $2,000 into a Roth IRA. That money will grow for 50 years. That's life-changing. If you're not sure you want to lock money away until retirement, a custodial brokerage account, like a UGMA or UTMA, is another option. These accounts are for general investing, not specifically for retirement. The money belongs to you, but an adult manages it until you reach the age of majority, usually 18 or 21. The downside: there's no special tax advantage, and when you turn 18, the money is yours to do whatever you want with, which sounds great, but some kids blow it on a car instead of investing it. The Roth IRA forces you to think long-term. For UK teens, the best account is the Junior ISA, specifically the Stocks and Shares Junior ISA. The annual allowance for 2025-26 is £9,000, and anyone, parents, grandparents, family, friends, can contribute. The money is locked until the child turns 18, at which point it becomes an adult ISA. All growth, dividends, and interest are completely free from income tax and capital gains tax. If you start at birth with the full £9,000 each year and get a 9.6% average annual return, you're looking at a pot of almost £500,000 by age 18. Even a fraction of that can change your life. For Canadian teens, the account you need is the tax-free savings account, the TFSA. You have to be 18 years old to open one, and you need a social insurance number SIN. In some provinces like British Columbia and Nova Scotia, you have to be 19. But here's the good news. Contribution room starts accumulating the year you turn 18. So even if you can't open the account until 19, you'll have 2 years of room waiting. The 2025 contribution limit is $7,000, and any unused room carries forward forever. The TFSA is a dream for young investors because gains, interest, and dividends are all tax-free, and withdrawals don't count as income. For early career earners making modest wages, the TFSA is almost always the first investing account to fund. For Australian teens, the rules are a bit different. Under 18s cannot directly buy shares or open their own brokerage account. Instead, a parent or guardian can open a minor trust account on your behalf, sometimes called a bear trust or kids account. The adult is the trustee, but the child is the beneficiary. The investments are held in trust until the child turns 18, at which point they can be transferred into an account in the child's own name. Importantly, this transfer is generally not a taxable event, so no capital gains tax on the transfer itself. However, there's a catch. Minors face higher tax rates on unearned income like dividends. The first 416 of passive income is tax-free, but after that, the tax rates jump to 66% or even 45%. That's punishing. So for Australian teens, it's smart to focus on growth stocks or ETFs that don't pay high dividends, companies where returns come from share price increases, not dividend payouts. That way, you avoid the penalty tax during your minor years. Step 3. Open the right account for your situation. Let me give you specific recommendations. In the US, if you have earned income from a job, open a custodial Roth IRA with a major brokerage like Fidelity, Schwab, or Vanguard. Fidelity offers a youth account for teens ages 13 to 17, a teen-owned brokerage account that lets you save and invest your own money while keeping parents connected. At age 18, the account transitions to a regular brokerage account for free. That's perfect for teens who want more control. If you're in college and 18 or older, open a Roth IRA in your own name. Even if you only work part-time, you can contribute up to your earned income. The 2026 limit is $7,000. You might not hit that, but every dollar counts. In the UK, open a stocks and shares junior ISA. Look for providers with low fees and low minimums. The Children's ISA has a minimum deposit of just £10. Hargreaves Lansdowne and Nutmeg are also popular options. You can only have one junior ISA of each type, so choose carefully. And remember, the account is locked until age 18. That's a feature, not a bug. It prevents you from raiding your savings for a spring break trip. In Canada, as soon as you turn 18 or 19 in some provinces, open a TFSA. You can open one at any bank, credit union, or online brokerage. The process takes about 15 minutes. You'll need your SIN and proof of residency. Then link your checking account and start contributing. The 2025 limit is $7,000, but your unused room from previous years carries forward. If you turn 18 in 2025 and don't contribute until 2026, you'll have $14,000 in room. In Australia, have a parent or guardian open a minor trust account on your behalf. Platforms like CommSec, Sharesies, and SelfWealth offer these accounts. Sharesies allows the transfer age to be set between 18 and 25. ComSec requires a simple off-market transfer when you turn 18, and because you were always the beneficial owner, the transfer is generally not a capital gains tax event. That's a huge advantage. Step 4. Decide what to buy and keep it boring. You're young. You might be tempted to buy crypto, meme stocks, or options. Don't. The goal at your age is not to get rich quick, it's to get rich slowly. The single best investment for a teenager is a low-cost index fund that tracks the entire stock market. The S&P 500 has returned about 10% annually over the last 90 years. A $1,000 investment at 16 becomes $100 at 17, $1,210 at 18, and so on. By 65, it's over $88,000. That's without adding another dime. So what specific funds should you buy? In the US, buy VTI, the Vanguard Total Stock Market. It owns every publicly traded company in America. Or buy VOO, the Vanguard S&P 500 ETF. Both have expense ratios of just 0.03%. That means you pay $3 per year on a $10,000 investment. In the UK, look for a global index tracker like the Vanguard FTSE Global All Cap Index Fund or an S&P 500 UCITS ETF. In Canada, these are all-in-one ETFs that hold thousands of global stocks. In Australia, buy A200, tracks the ASX 200, or IVV, tracks SUSIF's S&P 500. The key is low fees, broad diversification, and a long-term mindset. And here's the secret weapon: fractional shares. You don't need $300 to buy one share of VTI. Most modern brokers let you buy fractional shares, so you can invest $20 and own $20 worth of VTI. That's perfect for teens with small amounts. Step 5. Automate and ignore. Asterisk. Once you have your account set up and your investment chosen, set up an automatic transfer, even $20 a week, even $10 a week. Use the set it and forget it method. Do not check your portfolio every day. Do not sell when the market drops. The market will crash many times in your life. But because you're starting so young, every crash is just a sale. You're buying shares at a discount. The only way you lose is if you panic and sell. Here's a real-life example. A viewer named Emma started investing at 16 with $50 a month from her part-time job. She put it into a simple S&P 500 ETF in her custodial Roth IRA. By 22, she had over $4,500. By 30, over $15,000. By 40, over $50,000. And she never added more than $50 a month. That's the power of time. She didn't need to pick stocks. She didn't need to time the market. She just showed up. Now, let me address the biggest objection. I don't have enough money to invest. You don't need much. Many apps have zero minimums. Robinhood, Stash, and SoFi allow you to start with $1. Fidelity has no account minimums. The real magic is not the amount, it's the habit. A 16-year-old who invests $20 a month will have over $40,000 by age 40. That's a down payment on a house. That's a year of college tuition. That's freedom. Another objection: I need that money for college or a car. Fair point. You shouldn't invest money you need within 5 years. So if you're saving for a car next summer, keep that cash in a high-yield savings account. But money you won't need for 10, 20, or 50 years. That money belongs in the stock market. And as a teenager, almost everything is 50 years away. So invest aggressively. Let me give you a simple rule. Save 50% of every dollar you earn from jobs or gifts. Put it in your investment account. Spend the other 50% guilt-free. That's how you build the habit without feeling deprived. Now, let me talk about the one mistake that derails most young investors: overconfidence. When you see your friends making money on crypto or GameStop, you'll want to chase those gains. Don't. For every winner, there are hundreds of losers who lose everything. The boring index fund won't make you a millionaire overnight. But It will make you a millionaire over time. And that's the only reliable path. Here's a story that will stick with you. A study looked at the brokerage accounts of thousands of investors, the ones with the highest returns over 20 years. Many of them were dead, or they had forgotten they had an account. Because they didn't trade, they didn't panic, they just left the money alone. That's the secret. Do nothing, stay boring. Step 6, learn while you earn. Asterisk, investing is not just about money, it's about education. Use a stock market simulator like the one on Investopedia to practice without risk. Read one personal finance book a year. Start with The Simple Path to Wealth by J.L. Collins or The Millionaire Next Door. Follow financial YouTubers who teach index investing, not crypto flipping. The more you learn, the less likely you'll make expensive mistakes. And here's a bonus for college students. Many universities offer free access to financial literacy courses. Take them. Also, if you have student loans, understand the interest rate. If your student loan rate is over 6%, pay that down before investing. But if it's low, under 4%, investing is mathematically smarter. Now, let me give you a step-by-step action plan for the next week. Step 1. If you're under 18, talk to your parents or guardians. Tell them you want to start investing. Show them this video. Ask for help opening a custodial account. In the US, prioritize a custodial Roth IRA if you have earned income. In the UK, open a stocks and shares junior ISA. In Canada, get ready to open a TFSA on your 18th birthday. In Australia, ask your parents to open a minor trust account, STEEP 2. Open the account. Do it online. It takes 15 minutes. Use a low-cost brokerage like Fidelity, Vanguard or Schwab in the US, Hargreaves Lansdown or the Children's ISA in the UK, Wealthsimple or Questrade in Canada, and Comsec or Sharesies in Australia. Step 3. Deposit your first $20 or $5. Just start. Link your bank account and transfer the money. Step 4. Buy a low-cost index ETF. In the US, buy VTI or VO. In the UK, buy an S&P 500 ECF or a global tracker. In Canada, buy XEQT or VET. In Australia, buy A200 or IVV. Turn on dividend reinvestment, it's called DRIP. That automatically uses your dividends to buy more shares. Step 5. Set up a recurring automatic transfer of whatever you can afford. $10 a week, $20 a month. Automate it so you don't have to think about it. Step 6. Delete the brokerage app from your phone. Check your account once per quarter. Do not watch daily price movements. Step 7. Come back in 10 years and thank yourself. Comment below, I'm starting with $1 today. Be honest. I'll reply to the first 50 comments. And if you're a parent watching this, comment, I'm opening an account for my child. If this video gave you the roadmap to build wealth starting from zero, hit the like button. It helps other teens and college students find this life-changing information. Subscribe and turn on notifications. In the next video, I'm going to expose the dark side of the FIRE movement, what early retirees don't tell you about health insurance, kids, and taxes. You won't want to miss that one. You have a superpower that most adults would pay a fortune for: time. Don't waste it. Start today. Start small, stay boring, and watch your money grow. I'll see you in the next video.